Welcome to Pagoda Podcast, where we explore ideas, strategies, and insights to help businesses grow and scale.
Glad to be diving into this one. It's an important topic.
Yeah, looking through the research we've got today for this deep dive into the art of the investable pitch, it really highlights a massive gap out there in the business world. And honestly, it's almost painful to read about.
Oh, absolutely.
Because you have these founders, right? And they are absolute rock stars at running their companies.
Yeah.
They know the product inside and out. They love their customers. Their daily operations are super tight.
They're grinding every day.
Exactly. But then they walk into a room to pitch to an investor or a potential buyer, and it just totally falls flat.
It happens constantly. And you're right, it's painful to watch because the business itself is often fantastic.
Right.
But there's this fundamental disconnect between what makes a business successful to run and what makes a business attractive to actually buy.
And that is exactly the core of what we're unpacking today. This isn't just a guide on how to raise money or how to put together some flashy slide deck.
No, definitely not.
It's deeper than that. It's about increasing the perceived value of the entire enterprise.
Yes.
Because, frankly, you can build the best mousetrap in the world, but if you can't articulate the value of the mousetrap factory itself, you are leaving millions on the table.
Spot on. It usually boils down to a translation error. The founder is in there speaking the language of, effort and grit.
Yeah, sweat equity.
Right. But the investor sitting across the table, they're listening for the language of systems and scale.
Let's unpack that founder's dilemma right off the bat, because most founders I talk to, they really pride themselves on being the hero of the story.
Oh, they love.
They're the ones putting out the daily fires. They're working the 80-hour weeks. Why doesn't a professional buyer look at that and say, wow, what a great investment?
Because a buyer doesn't want to buy a job. If they look at a company and see a founder who acts as the superhero, the glue literally holding every single moving piece together, all they see is risk.
Huge risk.
Huge. If that founder leaves or gets sick or just burns out, the asset creates zero value. Professional buyers aren't shopping for a hero. They're shopping for a machine.
A machine that runs without them.
Exactly. An engine that keeps humming whether you're standing right next to it or you're on a beach 1,000 miles away.
So in a weird way, being too good at your job, being totally indispensable, is actually a liability when you try to sell.
It is the ultimate paradox of entrepreneurship. To build the business initially, you got to be hands-on. You're in the weeds.
You have to be.
But to sell the business or even to raise significant capital, you have to prove you've built something that totally transcends you.
Which brings us to pitching as a strategic skill. There is this myth. We see it in movies, shows like Shark Tank, where the pitch is all about passion.
The charismatic visionary?
Right. The founder who just wills the deal into existence with pure energy. But when you look at the data on what actually closes these deals, passion seems to be, kind of overrated.
Passion gets you the meeting. Structure is what gets you the check.
Structure. Okay.
See, passion is volatile. It's highly emotional. Sophisticated buyers like private equity firms or strategic acquirers, they don't bet millions of dollars on emotion.
No, they want guarantees.
They bet on structure. They want to know the floor isn't going to fall out from under them the day after the ink dries.
So it's vision versus viability.
Precisely. Vision is the dream. It's pitching where the company is going to be in 10 years. And that's exciting, sure.
But viability is the proof.
Viability is the proof. It's proving that the mechanics of the business actually work right now. A great pitch has to clearly articulate 3 things.
What are they?
The problem you solve, the solution you provide, and the one almost everybody misses, scalability.
Scalability. It's such a buzzword, though. Literally everyone says they're scalable. Oh, yeah, we can 10x our growth. But what does it actually mean to a skeptical investor?
It means answering a simple question. If I pour fuel on this fire, does it get bigger or does it smother?
That's a great visual.
Think about a service business that relies purely on manual labor. If you triple your customer base overnight, you have to triple your headcount.
Which is linear growth.
Exactly. It's hard, it's messy, the margins don't improve. Now look up a software company. You triple your customers, but your server costs only go up by maybe 10%.
That's real scale.
That is scale. Margin expansion. When you pitch, you have to prove that your infrastructure can handle aggressive growth without buckling.
Which leads right into those 4 pillars we see buyers hunting for. Clarity, predictability, scalability, and reduced risk. Let's break those down.
Let's do it.
Because clarity is one that really trips founders up. You'd think a founder knows their own business better than anyone on earth, so why is clarity such a massive hurdle?
Because they know too much. They suffer from the curse of knowledge.
Oh, that makes sense.
They get in the room and start over-explaining the nuances of their coding language or the specific logistics of their supply chain.
And the investor's eyes just glaze over.
Totally. The investor's sitting there thinking, okay, but how do you actually make money? If you can't explain the core business model in one clear sentence, you've lost the room.
Next is predictability. This feels like the direct antidote to the hero founder we talked about.
It is. Listen, investors hate surprises.
Good one.
Even good surprises are suspicious.
Really?
Yeah, because a sudden, unexplained spike in revenue suggests you don't actually control the levers of your business. You don't know why it happened. They want to know that if you put $1 into the machine on Monday, $2 come out on Friday. Consistently.
Which is why recurring revenue is the holy grail.
Subscriptions, retainers, long-term contracts, they are valued exponentially higher than one-off project work because they offer predictability.
And then there's reduced risk. I feel like most pitches focus 100% on the upside. It's like, look how huge this market is, and they just completely ignore the downside.
Total rookie mistake. A professional investor is trained to hunt for the downside first. Their very first thought is, how do I lose my money here?
Right. They're protecting their capital.
If your pitch doesn't proactively address the safety nets, your internal systems, and your risk mitigation, they just assume you haven't thought about it. And that makes you a dangerous investment.
That is a perfect segue into segment 2. We know they want safety. We know they want predictability. But where do they actually look for it? Because it's usually not in that pretty slide deck.
No, the slide deck is just the brochure. The real truth is buried in the data room.
The story builds belief, but the numbers build trust.
Exactly. You can stand there and tell the most compelling, passionate story in the world. But if they open your financial statements and it looks like a bomb went off, the deal is dead.
So what kills a deal specifically? Is it just that the profit numbers are low? Or is it that the accounting is messy?
Messy is always worse than low.
Really?
Yeah. If the revenue is low, we can have a logical discussion about valuation. But if the books are a mess, that turns into a, do I even trust a word you're saying discussion?
Give me an example of messy. What does that actually look like when you pull back the curtain?
It looks like a founder's personal expenses commingled with the business accounts. It looks like recognizing revenue the second cash hits the bank instead of when the service is actually delivered.
So cash versus accrual accounting.
Right. If a buyer can't clearly map out your unit economics because the data is absolute garbage, they have no choice but to assume the worst.
They price in the risk.
They'll assume your margins are much lower than you claim, and they'll slash their offer accordingly. Or, more likely, they'll just walk away.
So clean financials aren't a nice to have. They are literally the price of admission to even sit at the table.
Absolutely. And once they verify your numbers are real, then they start judging the quality of that revenue. We mentioned recurring revenue, but margins are a massive focal point.
The eternal battle between profitability and top-line growth.
But it shouldn't be a battle. It's incredibly easy to grow revenue if you're willing to sell dollar bills for 90 cents.
Anyone can do that.
Right. But proving you have healthy, sustainable gross margins, that shows the core logic of the business is sound. It proves you're creating real value, not just buying customers at a loss.
I want to shift to something you brought up in the research notes regarding operational health, specifically customer concentration.
That's a big one.
It feels like something founders totally ignore because, honestly, landing a massive whale of a client feels like a huge win.
It feels like a massive win today, but it is a nightmare for a potential buyer tomorrow.
Walk us through why.
Imagine you have a business doing $5 million a year. Sounds great on paper. But then we crack open the books and see that $3 million of that comes from just one single client.
The 40% gorilla. Or in this case, the 60% gorilla.
Exactly. If I buy your business today and that one client decides to switch vendors next Tuesday, I just lost 60% of my entire asset.
Wow.
It's an unacceptable level of risk. A buyer will discount your valuation heavily for that. They'll probably say, look, we'll pay you up front for your diversified clients, but that big whale, that money goes into an earnout.
Meaning you only get paid if the client stays.
You only get it if they stay for 2 or 3 years after the sale.
Ouch. So you basically end up working for your own buyout.
Correct. And the strategy to solve that isn't to fire your biggest client. It's to hustle and diversify your revenue base way before you ever pitch. dilute that concentration so the overall risk profile drops.
And this ties right back to systems. If the founder is the only person who actually talks to that whale client, the risk is doubled.
That is the classic bus test.
Right.
It's a bit morbid, but every single business owner needs to ask themselves, if I step off a curb and get hit by a bus tomorrow, does this company survive?
And if the answer is no,
Then you don't own a business. You just own a very high-paying job. You have to have documented processes, standard operating procedures, a leadership team empowered to execute the vision without you micromanaging the room.
I talk to so many creative founders who just roll their eyes at SOPs. They say, I'm a visionary. I don't want to be a bureaucrat making manuals.
I hear that all the time.
But you're arguing that boring documentation is actually a high-value asset.
Boring is beautiful. Boring is highly profitable.
Love that.
When a buyer opens your data room and sees a documented sales process, a structured onboarding process, a clear hiring pipeline, their confidence goes through the roof.
Because they can see the machine.
Exactly. They can see exactly where to pour the fuel. And that buyer confidence translates directly into a higher multiple on your valuation.
Right.
You are literally getting paid a premium for your paperwork.
That reframes it completely. You aren't doing paperwork. You're printing money for your future exit.
That's exactly how you have to view it.
Yeah. Let's shift gears a bit to the actual person standing in the room. We've got the clean books, we've got the boring systems. Now we have the psychology of the pitch itself.
Right.
You mentioned earlier that buyer confidence changes the value. But where does the founder's confidence come from? Are some people just naturally better public speakers?
No, not at all. I've seen incredibly charismatic, polished speakers completely tank a pitch because they didn't know their numbers.
Right.
True confidence, the kind that makes a skeptical investor actually write a check, comes entirely from preparation. It comes from being fully pitch ready before you ever step foot in the room.
It's the difference between hoping you have the right answer and knowing you have it.
Exactly. When a founder is just winging it, a sophisticated buyer can smell it instantly.
They get defensive.
They get very defensive when you poke at a weak number. They get vague when you ask about an operational risk. But when you are truly prepared, you welcome the tough questions because you already built a solid answer.
So how does positioning factor in here? Because you're not just reading a menu of your services.
Positioning is everything. You aren't walking in and saying, here is a list of the things we do. You are declaring, here is the massive opportunity we are currently capturing.
Framing the narrative.
Yes. You frame the business not as a static collection of products, but as a dynamic vehicle for capturing market share. You want the investor to feel like this high-speed train is leaving the station right now, and this deal is their only ticket to get on board.
But what about the skeletons in the closet?
Every business has them.
Right. Maybe there was a messy lawsuit 3 years ago, or a terrible down quarter, or that high customer concentration we just talked about. Do you try to hide it and hope they just gloss over it?
Never hide it.
Because they'll find it anyway.
If you hide it, they will absolutely find it during due diligence. And when they inevitably uncover it, two things happen immediately.
The trust evaporates.
1, trust drops to 0. 2, they start wondering, if they lied about this, what else are they hiding? And 9 times out of 10, the deal dies right there.
So you bring it up yourself. That feels so counterintuitive. Hey, everyone, look at my major flaws.
You don't present them as fatal flaws. You present them as actively managed risks.
Okay, how does that sound in a pitch?
You anticipate the hard question. You say, look, as you review our financials, you're going to notice our customer churn spiked in Q3 last year. Here is exactly why that happened. Here is the lesson we learned from it. And here is the new retention system we implemented to ensure it never happens again.
Wow. That completely changes the dynamic. You're not the victim of a bad quarter. You're the leader who fixed it.
It shows incredible maturity. Presenting a clear risk mitigation plan builds way more trust than pretending your company is flawless.
Investors know business is hard.
They do. They don't expect perfection. They expect competence.
Listening to all this, it really sounds like the pitch itself. That 1 hour you spend in the boardroom is just the absolute tip of the iceberg. The real work happens months, maybe years before.
That is the biggest takeaway here. The pitch is just the final performance. The rehearsal, the script writing, the set design, that's where the actual value of the company is created.
And this is what we're calling the pre-pitch phase.
Right. And it's exactly what we focus on at Black Pagoda.
Let's walk through that. If a listener is sitting here thinking, okay, I want to sell my business in 12 months, or I need to raise a Series A next quarter, what should they be doing today?
It always starts with an aggressive audit. We come in and look at the entire business strictly through the eyes of a deeply skeptical buyer. We want to tear it apart and find the holes before the investor does.
So you're stress testing it.
Exactly. We organize the financials, getting them out of the proverbial shoebox and making them truly data room ready. We clarify the growth strategy so it isn't just we hope to grow, but we will grow by pulling these three specific levers.
And you're actively fixing those risks we talked about.
Oh, yeah. If we spot high customer concentration, we launch a diversification sprint immediately. If we see key man risk with the founder, we start documenting processes and building up the leadership team.
You fix the house before you hammer the for sale sign into the front lawn.
You have to.
And doing that prep work, that must completely change the vibe of the eventual meeting with the buyer.
It stops being a grilling session. Think about it. If your data is messy and your story is full of holes, the buyer is forced to act like a detective. They're basically interrogating you just to find the baseline truth.
Nobody wants to be interrogated.
But when you present a highly structured, future-ready business with crystal clean data and proactive answers, the dynamic completely shifts. It becomes a collaborative conversation about opportunity. It changes from what's wrong with this to how big can we scale this together?
And that's really where Black Pagoda fits into the ecosystem. Acting as that trusted advisor to bridge the massive gap between running the day-to-day business and successfully selling it.
That's our entire mission. We do that heavy lifting, all that invisible pre-work. Whether you're looking to scale up and need capital, or you're aiming for an exit to sell the company for a life-changing amount, you need that underlying structure.
It's turning the founder's dilemma into the founder's advantage.
Exactly. We help you organize, grow, and eventually sell with total confidence because we've already done the hard work on the back end together.
I love that. It's really about taking control of the narrative by first taking control of your own facts.
You can't control the market. You can't control interest rates or the economy. But you can absolutely control how structurally prepared your business is. And preparation is the single biggest driver of an increased valuation.
This has been a fantastic deep dive into the actual mechanics of value. I think for a lot of our listeners, this is going to totally change the definition of pitching from just talking well to building right.
I certainly hope so.
If we had to boil this entire conversation down, what are the three key takeaways you want people to walk away with today?
Number one, clarity beats charisma. Do not rely on your charming personality to close a multi-million-dollar deal. Structure matters so much more. If an investor cannot understand your business model in one sentence, they won't buy it. Build the machine. Don't just act the hero.
Structure over personality. Got it. What's number two?
Clean data increases credibility.
The numbers build trust.
Exactly. Messy books are an instant deal killer because they signal incompetence and hidden risk. Get your financial house in order. Switch to accrual accounting, clean up your categorization long before you invite guests over to look at it.
And the third?
Prepare before you pitch. Do not wing it. The unglamorous work you do in the 6 to 12 months before that meeting, fixing the operational risks, documenting the boring systems, identifying the clear growth levers, that is what actually dictates the number they write on the check.
It's a powerful reminder that the best way to predict the outcome of your pitch is to design it beforehand. The confidence comes from the work. It leaves me with one final thought for everyone listening to mull over. What if the process of preparing for the pitch isn't actually for the buyer at all?
That's an interesting way to look at it.
What if building the pitch is actually the ultimate stress test for yourself? A way to expose the cracks in your own legacy so you can build a company that truly outlasts you, whether you sell it or not.
I couldn't agree more. A business that is ready to sell is simply a better business to run.
For everyone listening who is thinking, okay, I know I have a great business, but I am terrified of putting together that data room. Or if you're looking to scale and want to ensure you're maximizing your true value, you do not have to do it alone.
You really shouldn't do it alone.
You need to check out what the team at Black Pagoda is doing. You can visit www.blackpagoda.com to learn how to organize, grow, and sell your business with confidence.
We'd love to help you tell your story the right way and get the valuation you actually deserve.
Thanks for breaking all of this down for us today. It's been incredibly insightful.
My pleasure. Thanks for having me on to talk about it.
Thanks for listening to Pagoda Podcast. We'll see you in the next deep dive.